Will liquidity dry up? BlackRock limited withdrawal from a private credit fund. What happened here is not yet by itself a Lehman Brothers moment, but it is a real stress signal that you should take seriously. BlackRock held a roughly 26 billion private credit fund, received about 1.2 billion into redemption requests in the quarter, paid out $620 million and hit its 5% redemption gate for the first time since inception, which means the fund is doing exactly what these structures are designed to do when exit demand rises, for example, faster than the asset liquidity. The key lesson is that private credit can look stable on paper because prices are not continuously marketed in a liquid exchange, but that apparent stability is partially a function of illiquidity itself, not proof of superior resilience. Reuters and the news, they also reported that Blackstone temporarily increased a similar fund's redemption capacity to 7% with support from internal capital, while Blue Owl bought back part of one of its funds, which suggests as well this is not an isolated idiosyncratic event, but a broader sign that managers across the sector are actively managing liquidity pressure rather than letting markets discover it in a disorderly way. It's protection. The realistic interpretation then is that the system is under strain but not yet broken. Public market liquidity still exists, that it's true, and capital has not disappeared. And even the BlackRock's fund is still attracted 840 million of subscriptions in the quarter. But the point is the balance of power is clearly shifting from investors demanding immediate access to managers defending fund structure and asset duration. That matters because these funds, they lend to mid-sized companies through loans that cannot be sold quickly without discounts, and this is the liquidity issue. So if redemptions keep rising and credit quality worsens through higher defaults, the real danger is not an overnight collapse, but a slow repricing of the illusion of liquidity, where gates, delayed exits, side arrangements, and sponsor support become more common, and only later do valuation marks catch up to this new underlying and economic reality. For us, for you, the clean message is this: the news does not prove that private credit is imploding yet, but it does show that liquidity across the alternative credit complex is becoming more conditional, more managed, and more fragile, especially if macro volatility, defaults, and investor withdrawals continue to reinforce one another. We must pay attention. The liquidity bubble, it's the real bubble. Take care. See you next time. Bye-bye.